week?
Well, as of the end of the week, they're talking about a big run-up in oil that put a bid under equity markets. But they're really beginning to wonder about what they see as a little bit of a gamble by the Fed. That was reinforced last night when you had Janet Yellen and her three predecessors all together. And she, again, said that a inflation target of 2% was not ironclad, indicating she was willing to take some risk of an overage to make sure that the economic developments were improving on a more solid path.
Art, I wanted to ask you about the yen. Bill Fleckenstein said that was potentially the strength in the yen was a sign of chaos, meaning you were starting to see some of that carry trade unwind and go the other direction. Can you give me your thoughts on that?
Yeah, I do believe that you're getting some of that carry trade unwound. Conversely, the Bank of Japan, when they went to negative rates, seems to have induced the idea that people are unwinding that carry trade and forcing the yen higher just at a time when they don't want to see that happen. It's going to weigh on their stock market. The other thing that's going on is you can't forget that on March 1st, Japan went into a new fiscal year. So you may be seeing some of the exporting firms in Japan repatriating some money, and that could be causing currency shifts that they weren't ready for.
Art, you put out a note yesterday stating that we needed to take a look at the velocity of money. That release was coming out. What is that looking like at this point? Any changes?
Well, yes. M2 has moved up, but conversely, in a countervailing sense, the Bank of St. Louis released the monetary base. Now, the monetary base is what the Fed can do directly. If you can grow the monetary base, then ordinarily it would indicate that you can begin to get monetary velocity and get some inflation. So let's separate the two. The reason I wrote about the velocity in money is that it has been completely absent pretty much for the last 7 years. As much as the Fed has tried to ease, the analogy I've used before with you, Eric, is that it was as if Ben Bernanke flew over your house and dropped a million brand new printed bills on your lawn, and you went out and you were so nervous. You just picked them up, scooped them all up, and put them in your garage, not spending them, not using them, not anything. And that's exactly what has happened here. With lacking any velocity in money, people are just taking the asset and keeping it sterile. Now, the fact that the money supply has begun to grow is important because it could be a hint that money is picking up some velocity. In essence, that you borrow and then deposit money in the bank, and they lend the same money out again and again several times under the reserve banking system. And that, in a traditional sense, is one of the things that can lead to inflation. And that's why it has been very interesting that the money has lacked velocity. And here we have Yellen saying that she's willing to tolerate a little bit more inflation just to make sure the rest of the economy is going well. And the reason that I wrote it up was two things, obviously, because it's beginning to change velocity, but it's also a potential real risk for the Fed. So far, with all of the reserves that they have pumped into the system, we have had little, if any, inflation. But if suddenly the velocity of money began to pick up sharply, you run the risk of that smoldering, non-inflationary look suddenly bursting into a wild inflation. For completely different reasons, you had that back in the amazing inflation in the Weimar Republic in the 20s in Germany. Now, that was a completely different thing because that was not so much them pumping in by buying bonds. They actually printed more money. But even there, initially, inflation didn't appear instantly. It was quiet, and then suddenly it exploded. So given that historical precedent, even though the methodologies are different, that makes me wary enough to keep an eye on M2 and whether we have velocity of money in the banking.
Art, what about the action in gold? It's been strong, but the miners have traded even stronger with the Huey Gold Mining Index hitting the highest level in 2 years.
Yeah, I think people are beginning to look at gold in a slightly different fashion, and part of that may be attributable to negative interest rates. If negative interest rates begin to move even more negative, then you're basically, savers have been frustrated because they are getting little, if any, return on their money. But if you go negative, and it goes broadly negative, then you're actually being punished for saving, that the value of the money that you have saved deteriorates. That, in essence, you would be much better served to not have your money in the bank, but have your money in your mattress, because at least the mattress would not be, through negative interest rates, charging you to hold it. And therefore, people, I think, now have begun to look at that as a distinct possibility. Now, there are a couple of ways you can do that. One, you can have absolute cash, but that requires that you hold it, for space reasons, in large bills. And you see that they are battling in Europe to end the 500-euro bill. Their battle, Larry Summers and others, are moving strongly to try and get rid of the $100 bill here in the United States. They are trying to push people out of the cash market and into, if you would, strictly digital money, which the government can more readily control. So now, if I look at that and I say, gee, they're already thinking about basically calling in the large bills, et cetera, what else can I do the equivalent of putting money in my mattress? I can buy gold. And I'm holding the gold, and wherever I'm holding the gold is not necessarily charging me any money, as opposed to the bank, which will charge money if we go to extensive negative rates.
Art, you were very vocal that the Fed never should have raised rates, you and others, but they stopped doing that after one rate hike. How bad is the situation that the Fed faces?
I think it is extraordinarily difficult, and I have said that I believe we have a high likelihood of seeing zero again before we see 1%. And I think there is real fragility in this market. Fed talks about the global fragility. Christine Lagarde has said the global recovery is in serious trouble. She is lobbying, as usual, the Fed and Janet Yellen not to raise rates anymore on the fear that it could be the thing that tips over the apple cart. And so I think we still have a rather fragile outlook for the global economy. And I think at some point the Fed could even be forced to take back that December rate hike.
You and I have always warned that excessive money printing cannot create prosperity. Maybe that's a bit of Austrian economics, but this is what I want to ask you today, Art. How will this all end, in your opinion? What do you think will really happen in the future?
Well, it's obviously very difficult to say. If the economy continues to stagnate, we got inventory data today that probably will mark the GDP down even further. So there's a chance that you will see virtually no growth in the GDP in the first quarter. And that will bring in some difficulties. Now, you have an election year coming up. You've had both Trump and Ted Cruz talking about an audit of the Fed. The Fed itself may become a political football as we get closer to the election. And that may either inhibit them from moving or make them move a bit faster and in a manner to avoid criticism. And I do believe they may become a political football, which could neutralize them at a time when it's pretty evident that both the Bank of Japan and the ECB are ineffective. So I'm not going to give you a detailed answer because it is so murky. It is hard to see, and a lot will depend on how the remaining central bankers react. So far, the Bank of Japan has been proven to be amazingly ineffective. I mean, look at what has happened since they went off on this thing about, don't worry, we're going to double down on the money. They keep doing it, and it doesn't happen. And now that they've gone negative, the yen is moving higher. So things are not what what they are said to be in the textbook. So the end result is not quite knowable yet.
You know, Art, when I hear you talk about this, you're basically saying none of this makes any sense. We've got the yen strengthening when the rates have gone negative, and people keep talking about Japan and how they're basically bankrupt and insolvent, but the yen goes higher. And I understand there's a carry trade there, but really what I'm hearing from you is it's hard to quarterback this thing because it's a great monetary experiment that could end in tears and probably will, but we don't know.
That's absolutely right. I mean, the Fed and the Bank of Japan in particular has been kind of making it up as it goes along. And people have published papers on what you might expect to have happened if you went to quantitative easing and a variety of other things. But they have not. It has not happened. You wound up raising an asset class where the Fed is being criticized for, quote-unquote, helping Wall Street while deserting Main Street. I'm sure that was never their intention. But they have not been able to push that quantitative easing into discernible growth on Main Street. And all they've gotten is higher stock prices and a new brand of what is now being called financial engineering, where it has been cheap enough for companies to buy back so many of their own shares that their earnings look higher, not because their business is growing, but because they reduced the number of shares that they have. And that's become a bit of a pillar under the market, too. So this is economic terra incognita. Nobody knows what is out beyond that stream. And we're learning, unfortunately, as each day goes by.
Final question, Art. I always ask you this. You've been doing this for over half a century. What is your biggest fear right now? What has you concerned?
I think my biggest fear is that if you have that accidental slip, if suddenly and unexpectedly monetary velocity began to pick up and the Fed would find itself not one step behind, but probably 12 steps behind. Because at this very critical moment, they have announced that they are willing to tolerate a bit more inflation than ordinary because they are so concerned about the rest of the economic picture. So I am concerned, as I say, it happened in a different fashion in the 20s in Germany, that you can miss the gate, that inflation could begin to pick up as the monetary velocity does, and the Fed could find itself well behind the game. And that would be very unfortunate and have rather bitter consequences. But we won't know that for probably another couple of months. So we'll have to redo this interview a couple of months from now when we begin to see if velocity has actually